answering your tough financial questions for the past 26 years. It's Allworth's Money Matters with co-hosts Scott Hanson and Pat McClain. Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hanson and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH. Want more of Allworth's Money Matters? Visit allworthfinancial.com/radio to get the Money Matters podcast.
Welcome to Allworth Financial's Money Matters. I'm Scott Hanson.
I'm Pat McClain.
Glad you are with us. And this is our first week that we are officially calling ourselves Allworth Financial.
Yes.
So,
Allworth.
Allworth. And
for all it's worth.
As you know,
I don't think that's what they meant.
For what it's worth. Both myself and Pat here are both financial advisors, and we help people, and we are in the weekends to help you as well.
For financial things. Yeah.
For financial things.
Financial stuff.
Yeah.
Anything regarding all your worth, right? 401ks, wills, trusts, taxes, college funding. We'll even talk about life insurance if you so desire. We can answer those questions as well.
And if you want to join the program, if you've got a call for us, we'd love to take it. The number to join us, 1-833-99-WORTH. Again, to join Hanson and McClain's Allworth Financial's Money Matters, 1-833-99-WORTH. And numerically, it's 1-833, which is toll free, 996784. And apparently the 800 numbers are taken, and the 888 numbers are taken, and the 877 and 866. So I guess we're now on 833.
But how much really does a phone call cost nowadays that we need to, like, you're like, oh, I'm not going to call that firm because I don't want to pay them.
It's pretty much free now, right? I mean, not free, but it's all, doesn't really matter.
It's all like a package, right? So you're like, oh, I'm not going to call them. It's not like when we were growing up where you'd only talk to your grandmother after 9 o'clock on a Sunday night.
I had a girlfriend, must have been a senior in high school, and she lived in the zone away where it was a toll call.
Yes.
And my parents, every month, I'd go through the bill. Here's the calls to your girlfriend.
Oh.
Hope my wife's not listening.
Was it worth it?
No. I don't know. It was, I guess, at the time. I don't know. What do you mean, was it worth it?
I just remember when we were growing up.
What do you mean, was it worth it? This is my high school girlfriend. How am I supposed to answer that question now? I regret ever knowing the girl?
Yeah, was it worth the $8 I had
Apparently
invested in
it
this
was.
communication?
I think I was quite infatuated with her.
At the time.
She's kind of my first girlfriend.
What would happen if you had taken that money and put it in a well-balanced portfolio? How much would it be worth today? That's what you should compare all your expenditures are.
In a previous relationship I had.
Or any of your expenditures when you were younger. Had you taken the money and put it in a well-balanced portfolio?
I told my wife, had we skipped our big wedding and had a small one down at the courthouse.
Right? Look at how much money
and taken that money.
How much money?
Yeah.
Lots of money.
That would be that's the right kind of way to look at life. That's a beautiful way to view life.
So let's spend a little bit of time. Let's talk a little bit about how industries change and actually how companies change within industries. So if you remember growing up.
It's always good to look at these because whatever the hot company is today, they're not going to be hot forever.
And some of it has nothing to do with them. It's just legislative risk. So let's think about this. When you were growing up, I'm 55, 56.
I'm 52.
When you were growing up as a kid, you remember the phone was like, you can't do this or that because it's expensive.
Yeah. Well, and it was attached to the wall.
It was, with a cord and the whole bit.
One cord that's about 20 feet long, so you can walk around.
Exactly. And the phones were owned by the phone company at that point in time, right? So they owned every part of it.
Hardwired in.
Deregulation happened. Why did deregulation happen? Well, because Southern Pacific Railroad actually lobbied Congress in order to deregulate telecommunications. Why would they do that? Well, Southern Pacific Railroad had right-of-ways between their Kansas City office and Chicago. And rather than pay the phone company the tremendous bill, they just took a wire and ran it between their offices. One day someone said, we're not using all the bandwidth on this wire. Let's sell it to someone else. Against the law, lobby Congress, allowed it to go through. The word Sprint stands for Southern Pacific Railroad Internetwork Telecommunications. Prior to that, the phone companies had a monopoly. What happened to those phone companies since that happened? They had guaranteed income basically back then. They could do no wrong. The PUC set the rates. The same thing happened in airlines, right? And also in electrical generation and distribution.
And that part is still going through a bit of a...
That is it. That's the last to fall. So what you parents bought because it had guaranteed income 40 years ago is probably long, long gone.
Well, I think a good lesson here, and I appreciate the history story there, Pat. Thank you.
I found it fascinating.
You had all the little details, the cities. It's just perfect. I should bring you into my kids' class, and you could teach the history lesson on the history of the phone company. Why your cell phone calls are free?
Okay, are you through making fun of me? What can we learn from this?
Every industry changes. Every industry goes through some sort of contraction. Every industry.
Doesn't matter what it is.
Whatever's hot today will not stay hot forever.
That is correct.
And particularly the closer you get to retirement, the more important it is that you are not overweighted in some area where if there is some legislative risk that happens, fire risk like you saw in California with PG&E.
Risks that they call black swan events that you couldn't even predict is going to happen. That you couldn't even predict.
GE is a prime example of one that went from
crazy
top of the world to no one wants to admit they own any GE stock today.
Yeah. And back then it was the stalwart. It was what you owned.
Oh, people talked about that's highly diversified. You don't even need to diversify outside of GE.
Yeah. You never know.
Bad. If your retirement was bet on that, you're back working. I hate to say it. And the fact is, as you get later in life, it's much more about keeping what you have than it is about getting more. It's much more about maintaining your lifestyle. Most people at retirement stage are more interested in maintaining a lifestyle than they are about becoming wealthier.
So,
at the risk of going broke.
Correct. So it is at some point in time, it goes from accumulating worth to storing worth is what a portfolio should be doing. It's a where you could store your worth over a period of time
and generate some income.
Yeah, in an efficient manner.
It definitely changes. All right, let's take some calls. To join us, both Hanson and McLean at Allworth Financial's Money Matters, 1-833-99-WORTH. We're in Colorado with Jeffrey. Jeffrey, you're with Allworth Financial.
Hi, thank you very much for taking my call. I'm 64 years old, and my wife will be 62 in 4 months. And we both have earned our own Social Security benefits. However, for my wife, the spousal benefits will be greater than her own benefits, even if she waits until full retirement age or even longer.
Okay.
So I plan to wait until my full retirement age of 66 and 2 months to begin collecting my benefits, which is approximately 2 years away. My wife would like to begin collecting benefits on her own earnings when she turns 62 later this year, and then receive spousal benefits once I begin collecting. So I have 2 questions. Is this allowed under the rules? And if so, how much will her spousal benefits be reduced by her starting?
Yeah, that's the bigger question. That's the bigger question. So, yes, you can do this. What has changed, it used to be where someone could what's called file and suspend. So, and what that meant is the rules have just changed, and you weren't
old enough.
Yeah. But let's assume you are full retirement age today. You could file, say, I want my benefits, and then immediately say, you know what? I have applied for them, but please suspend them. I'll turn them back on at some time in the future. And by doing that, it would enable your wife to sign up as a spousal benefit. So she could get a spousal benefit until at some point in time, let's say age 70, you'd say, I'm going to go ahead and receive my benefit, and then they can go back to their own. So,
but that's changed for most people, not all. Some people still qualify.
But the reality is, your spouse can go and start collecting Social Security at age 62. It would be a reduced amount, right? So the normal retirement age is probably 66 in a couple months or something like that. So the benefit would be 60 some odd percent or 72% or something like that of the normal benefit.
Close, yep.
Because that number's a moving number.
80, so it goes down from 80%.
Yeah, but it's when it was
70,
65. So it's 70,
74, 75%.
Okay, so let's assume she would qualify for $1,000 a month. Now she's only going to be receiving $750 a month. Suddenly, a couple years down the road, you apply for your Social Security, which triggers on hers, wait a minute, the spousal benefit's larger, so it increase, but she would still be at that reduced amount.
So it would be 75% of
the 50%,
which may or may not, which you may or may not decide that she should actually start taking benefits at 62.
Mm-hmm.
So based upon the overall situation.
Yeah, because her benefits might be so low that she would be locking herself into a reduced spousal benefit forever.
And
for a few bucks.
Assuming that she has a normal life expectancy, assuming that's one of the questions, and you have other assets that you can use in order to support those dollars, you may want to use the other assets. So if you go to our website, there is actually a Social Security workshop.
Tutorial.
That will kind of walk you through that.
Allworthfinancial.com in our learning library. There's a tutorial on it. But having said that, the Social Security, it really needs to be analyzed in conjunction with every other area of your life. What's owed on the house? Is there any pension coming in? What do we have in 401ks? Are there money sitting outside of 401ks? How much money in savings? Are there any real estate property all those things should be figured in.
What's your life expectancy?
Yeah.
So how much assets are there outside of the home in 401ks, IRAs, brokerage accounts, savings accounts? What's the dollar amount on that?
1.1 mil.
Okay. Like and is your home paid for?
Yes.
Okay, I would not have her take it at 62, just if she has a normal life expectancy. I'm just going to tell you flat out. Wouldn't have it. I'd wait. And I'd spend down that part of that.
But the way to do it, there are calculators. You can run the numbers.
Yeah, but I know where he's going to end on this. We could run the numbers, but I tell you, we've been doing this long enough,
Depending how much what is her benefit? Do you have any idea what her benefit would be?
Taking it early, it's $700.
And how much will her benefit be?
How much is your benefit today? Just assuming.
Well, my full retirement benefit will be $3,000, so 50% would be $1,500.
She's gonna wait. She's gonna wait. If you sat in my office, I'd go through the exercise of crunching the numbers and pretending that the numbers were going to tell me the answer. But the reality is, we've been doing this long enough. You want to wait. You want to spend that $1.1 million down and defer Social Security, assuming
he has to spend it down.
Yeah, assuming that she has a normal life expectancy.
Okay.
But if you want to run the numbers, meet with an advisor. They've got they can crunch all the numbers and run the calculations, and you can see the trade-offs.
Yeah. Easy enough, so watch the tutorial and tell your wife, maybe she's got some sort of desire to take the money. Who knows? But it's not.
She's just waiting for that age 62, get that monthly check, and watch out.
Yeah. It wouldn't be the best thing for you financially. All righty?
All right. Thank you.
All right. Glad you called, Jeffrey. Wish you luck. And it is so confusing, Pat, on the Social Security stuff. Just because it's complicated, right? Every situation's different.
Yeah. And that one, if he didn't have that $1.1 million, if it was $50,000, I'd probably give a different answer. Could possibly give a different answer.
Yeah. All right. To join our program, 1-833-99-WORTH. You're pointing at me.
Yeah. So think about Social Security as a pension. Forget everything else connected to it. It's just a stream of income. That's all it is. It just happens to come from the government. And it has some legislative risk associated with it. But all pensions have legislative risk associated with them.
There's some risk involved in anything.
Through the form
everything
of
in life. Yeah.
Through a form of taxation. So if you were electing a pension, you'd put time and energy into thinking about how you would take those dollars in light of the rest of your financial situation.
Well, as you should with Social Security.
Yes.
Let's go to Littleton, Colorado, talking with Ron. Ron, you're with Allworth Financial with Hanson and McLean.
Hello, how you guys doing?
Hi, Ron.
Hey, so I'm thinking of selling a rental property, and I've heard of a fund called Opportunity Zone funds.
Okay.
Are you familiar with them, and any idea what kind of returns they get?
Oh, so you are selling this, and you're thinking about doing a tax-free exchange into an Opportunity
Zone
fund. I actually don't know whether they would qualify or not, so I don't know. Do you know would an exchange qualify?
It should. Yes. Okay. There's some tax benefits in some of these opportunity zones.
Yes.
That have changed and continue to change.
And have in the past changed. So what makes an area an opportunity zone?
Whatever the government states it's going to be an opportunity.
Right.
Here's so Ron, if you called and said, I've been a real estate investor all my life. I've got a couple commercial properties. I'm thinking about exchanging one of my properties for something in an opportunity zone.
In an opportunity.
Building a new building in an opportunity zone, participating in building a hospital, whatever it might be. That's one thing. If it is exchanging some property and then becoming a tenant in common, which is probably how this would be structured,
in a fund that invests in opportunity zones.
My guess would be the fees that, when you calculate all the fees involved, are going to be more than the tax savings you'd have by the opportunity zone.
I would not ever roll money over to any tenants in common with a disparate group of investors that you don't know or have never had a relationship with in the past. That's just a fact. I don't care whether it's an opportunity zone or if it's a Trump palace. It doesn't make any difference to me. It's a tenant in common. The structure behind it is
so what is being recommended?
To me?
Yeah. And why you consider selling?
Nothing's being recommended. I'm trying to reduce my taxation on my capital gains. I'm selling a rental property.
Why are you selling it?
To reduce my capital gains. I'm just getting old and tired of taking care of it.
So your options now, right? Either you cash out and you pay the capital gains, or you exchange it into a like-kind property directly, which you could then you would have direct ownership like you've got now. That's an opportunity. Or you put it in you pool it with other investors, and your legal structure is tenant in common, which is, in my opinion, a disastrous structure want to make your life simple.
You know what?
I've got a client, and I have a client who did an exchange as a tenant in common, and she ended up having capital calls. It was a couple $100,000 of capital. She ended up having capital calls because they invested in a nursing home, and and I think another nursing home opened up in the same region. And
did you recommend not investing in it?
She'd already have it. I've always recommended staying away from these things.
True. Scott and I owned a property together. We wanted to sell the property. This was earlier this year. Wanted to sell the property. We looked at doing a tax-free exchange into a different property. Could not identify anything that I would buy today. What did we do, Scott?
That's right. This is a property we bought after the last downturn.
You and I owned it 50-50.
That's correct.
It was a rental property.
We recognized the gain.
We recognized the gain. We pay taxes on it. Why? We most certainly would never have rolled it into a tenant in common with people that we didn't. That was a syndication that put it together, because that just doesn't. There was nothing that I would buy today that was appealing to me. So we recognize the gain. We pay taxes on it. Is it the most tax efficient? No, but it was the best. What we felt was the best business decision at the time.
Yes.
Is to take the tax hit on that particular property.
And you're getting rid of the rental. It sounds like you're tired of dealing with it, right?
Yep.
You want to make it sound like you're trying to simplify things so you can focus on things that are important to you.
Ron, which is one of the reasons we got rid of the rental.
Okay.
Because you hated it.
Well,
I hated it.
And it didn't really involve you much.
It involved me some.
But the challenge is to go down the path of an opportunity zone. You're creating new. There's either new headaches by having a direct ownership in something, which is you're trying to get rid of, or you've got new headaches by being a tenant in common, which would
It's a terrible
not
structure.
be a. Yeah.
So appreciate the call.
Okay. I was very skeptical of them too, but so I appreciate your help there. Thank you.
Yeah,
Appreciate
I'd stay
the
away
call.
from 'em. And it's funny. It's like taxes can drive investments. I'd never forget, Pat, because you remember as well. We've been doing this long enough,
Yes.
so we've seen run-ups in all the markets, real estate, homes,
Tech
gold.
stocks.
We've seen it all, right?
Yeah.
Up and down. We've seen it all. We've
Well,
seen
we
the market
think
cycle.
we've seen a lot. We haven't seen. We
fair.
don't know what the next one will be, but there will be another one.
Fair enough. But the one thing that impacted the majority of Americans was the housing boom, right? Leading up to the Great Recession. And it was so common for people to, no one ever wanted to realize a gain.
No.
Never.
And if you have listened to our show that's been on the air for 23, 24 years, back then, you would have heard us say, don't buy right now or recognize a gain if you sell. We said it commonly.
Well, unless you've got a 5+ year holding, but most of the time it was a pure investment play, and everyone wanted to
Just make some quick money. Right? So your point being is sometimes you just recognize the gain and take the profits. That's it. Now let me.
It's the same thing. It's the same thing with individual stocks or even mutual funds. And I got to tell you, one of the interesting challenges as a financial advisor, we've been advisors for a long time. If someone comes in, you build a diversified portfolio. Our philosophy is rebalancing is important.
Sometimes in a rebalance outside of an IRA, you have to recognize gains. And that's important. It's important. Some clients say, I don't ever want to be. We can do that as well. The problem with that over a series of years is the portfolio gets riskier and riskier and riskier. And unless you can mitigate the risk somewhere else in the portfolio,
But sometimes you can.
which sometimes you
can't.
Sometimes you can't. Sometimes you can't.
But a capital gain is always better than a capital loss.
Always. So
Always. And when you invest for what? Gain. Do you not?
and so but
Did you see, speaking of gain, do you see that there's that? I don't want to talk politics.
But I do want to talk about opportunity zones in general, though, Scott. What they create, opportunity zones, is the government actually messing with the fair market by taking companies or individuals' monies that have been successful and reallocating it to areas, geography, where they haven't been successful. That's all an opportunity zone does, is it distorts a marketplace. Because the government said, this part of the market is not doing as well as we think it should. We're going to actually make them more competitive with someone down the street that lives on the outside of that particular opportunity zone and effectively take the successful person's or company's money and give it to the unsuccessful. That's all it does. It distorts the marketplace, right? It doesn't allow the marketplace to act freely.
Correct.
Yeah, which is why I have a philosophical problem with the idea of opportunity zones,
As well,
right? Because it's not allowing for the most efficient use of capital to flow.
and you
where it
believe
should be.
over a long period of time, it's not going to be of help.
Correct. It distorts. It causes people to actually make decisions that they wouldn't otherwise make because the government is some sort subsidizing.
And
it in
the
a form.
challenge, anytime you're in business with the government,
They can
change.
the rules.
Have we not seen that enough over the years?
Yes. Yes. And we've seen these opportunity zones come and go, especially in the state of California. especially in the state of California.
Yeah. And part of our belief is for most people, keeping things simple
Is better.
Complexity does not necessarily yield greater returns, nor a greater life.
In fact, exactly the opposite.
It's funny. Part of our what we call our just cause is for people to live rich and meaningful lives.
We didn't say rich and complicated.
No, I mean,
right? Adding complexity doesn't necessarily make it better.
yeah. So we're taking a quick break here. When we return, we'll continue back with calls. If you want to join us here at Allworth Financial's Money Matters, 1-833-99-WORTH is the number. Numerically, it's 1-833-999-6784. We'll be back in just a moment with Hanson and McLean's Allworth's Money Matters.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast. Do you have a financial question that needs answering? Call us at 833-99-WORTH. That's 833-99-WORTH.
All right, welcome back to Allworth Financial's Money Matters. Scott Hanson.
Pat McLean.
And glad you are sticking around here with us. And to join the program, 1-833-99-WORTH to join us.
Let's give the numerical. It's 833-999-6784 if you'd like to join the show. So 833, which is toll free, 999.
Not again.
6784. Not again.
Hey, the term toll.
Okay.
No, we're not going there.
Think about it. Anyway, I like esoteric stuff like that.
I know. You read a lot of esoteric books.
I'm reading two right now, which are fascinating.
And what are these on?
One's on cotton and the cotton's influence on actually the United States and around the world, which was probably one of the first global exports was cotton.
Through slave labor.
It didn't start as slave labor, but it turned into slave labor. And then the other book is about Comanche Indians.
The Comanches. So we took the Comanches' land to plant the cotton.
Where
were the Comanches?
The Comanches were actually...
I might enjoy that book, actually.
The Comanches were actually pretty good at taking land themselves from other Indians. So let's not... That, in fact, was...
They weren't all singing Kumbaya?
They were actually... It's interesting. The Comanches, Scott, were really... Until the horses migrated from... from Mexico.
And I should ask every week now, which book back to me? Because you read a lot of books.
Quite fascinating. And I'm not going to talk anymore about the Comanches, but the Comanches were actually not a very, very strong tribe until they actually mastered the use of the horse. And then they just became incredibly powerful.
Oh.
Because they were actually able to use this new technology to them called the horse.
And it displaced
lots of people.
All right. Thank you for that. Let's go to Sacramento.
In fact, there is a hypothesis that the reason Mexico gave Texas to the U.S. is to create like a little barrier from stopping certain Indian tribes to come into Mexico. That's what the hypothesis is. Anyway.
Well, it's interesting how history is because the longer it goes,
it changes.
It kind of does. Doesn't it depend on someone's perspective.
Who's telling the story.
That's right.
But anyway, if you could listen, you can tune into our podcast as we review books during our financial talk show.
Yeah, lovely. All right, we're in Sacramento talking with Russell. Russell, you're with Allworth Financial's Money Matters.
Thank you for taking my call.
Yeah.
So I've heard you folks talk a lot about the benefits of getting fee-based financial advice rather than dealing with salespeople. But I understand that a lot of investment products like mutual funds are structured to be sold through an agent who receives a commission or a load. So my question is, don't fee-based advisors ever recommend such investments? And if so, where does that commission go?
Oh, that is a great question. Right? That is a great question. And for the rest of the listeners, this is how it used to be. When we entered the business back in the day, there were not a lot of fee-based investment advisors out there.
No, and most mutual funds had what's called a sales load.
Right. So,
and when they first started, they were typically 8.5%. So if you go back 40 years,
you would buy from a particular mutual fund company something, and they would charge you a commission. So you put $100,000 in there. There were break points, but if you put $100,000, you might only see $94,000 of it invested. The rest of it went in the form of commissions. So that changed over the years, and those were called A shares. So you say, Bill, it would call the Great Mutual Fund, and then
well, they weren't called A at the time; they were just
mutual funds.
Yes.
Then they started pricing them A, B, and C shares, and then no load. So even today,
and let me just bring this up as well, because as things began to change, the mutual fund industry lowered that front load from 8.5% to was 5.75% typically, but they added on an additional quarter percentage point, or 0.25% under what they called a 12B1 fee, which is essentially another commission.
They called it a servicing fee, or
whatever.
12B1, but it was essentially another commission. So there are some firms that are fee-based financial advisors that still sell these A shares at what they call NAV, or net asset value.
They waive the load.
They waive the load, but there is still this 0.25% fee that goes to the investment firm that is, you call it what you want. It's a commission. Where does that money go? It goes to the investment firm normally, not to the advisor. So I know of a very, very large national firm that's owned by a company that most people, or a lot of people, are familiar with, where a large portion of what they recommend has this buried 25% basis point fee, and they get away with calling themselves a fee-only advisor, which I don't know how that works. Firms like ours, we don't
use those products.
It's radical transparency for us.
And most of the load fund companies have a share class
that has
just a different packaging, essentially. It's the same exact portfolio. They've just stripped down the fees. It's just lower fees, and they're only available through institutions and through like financial advisory firms. So as an example, at Allworth Financial, which is, I'm still having trouble saying Allworth Financial from Hanson McLean because we just switched our name. But at Allworth Financial, as of many other independent advisory firms, our clients, their accounts are held at firms like TD Ameritrade or Charles Schwab or Fidelity. That's where the accounts are held. And then we act as advisors and choose the funds that are in there, the securities that are in there, and then manage them on an ongoing basis. We don't have any funds in there that have any loads paid.
Not a penny. Not a penny to us. But the question was, what happens to the ones that do? It ends up at the firms, not normally at the advisors. And in fact,
or the investor, because they can always use a different class of funds.
That's correct. The investor pays for it. It's just
Yes.
a hidden fee. Does that answer your question, Russell?
Yes, I believe so.
So if you're
the
looking
bigger
at,
question I have is, how do you have this question?
yeah, what prompted this question?
Oh, it's something that I've wondered for many years, because I used to know people who would take their 40-hour class on how to be a financial advisor, which meant they were really going to be marketing some mutual fund, and they were in it for their commission, their load. So when I think about fee-based advisors, I wondered what happened to that.
Yep. Good question.
Yep. And it still exists out there. So if you own it,
I know of guys who would. I mean, our industry's got some bad actors. About half the industry I wouldn't trust. They're either inept or unethical or both. Because I know of advisors that would sell somebody loaded mutual funds, take the commission, and 6 months, a year down the road, they would convert them to a fee-based account. And
which means that they charge the fee on top of the commission.
Yeah. Double dipping.
So
not good to the client.
if you're out there and you've got a fee-based advisor and any of your holdings have an A behind them, it will say like the name of the mutual fund, and then A, you don't want that in your portfolio.
Unless that's the only option that one particular fund company has.
Come on, Scott.
Okay. Well, no, I don't. I mean, it's almost. I don't know of any mutual fund company that doesn't have an institutional class available.
Yes.
You want the lowest. Your advisor. First of all, your advisor has a fiduciary duty to pick
get you the lowest cost. Right? And your advisor has a fiduciary duty to you to make sure that a portfolio is appropriate, which may mean and should mean the lowest cost to get to the desired result. The fee that the advisor actually charges, it doesn't violate any sort of fiduciary duty one way or the other. They're going to charge a fee. You get to decide whether you're going to pay it or not. So I appreciate the call.
Wish you will.
So let's talk about this for a little bit. So I have 4 children. 3, one has graduated from high school, one has graduated from college, and 2 are in college. So I get the phone calls all the time from my children's friends. You probably do as well, Scott. I'm thinking of getting into your business, Mr. McLean. I insist that all my children's friends call me Mr. McLean.
It's like when they're 25. You can call me Scott now. At what point are you am I going to be Scott?
When they're 40. So our business is a very, very difficult business to enter into unless you're selling commissioned products. Or you're working it's a very difficult business to enter into because the jobs that are available to most of these people are commission sales jobs where you're selling life insurance.
Equity index annuities.
Some sort of, they're oftentimes disguised
as financial planning.
It's financial planning. So the conversations I have with these people are, if you're going to work for a company that is owned by a life insurance company and they tell you it's financial planning, you're probably going to be asked to sell life insurance.
How do you know?
You actually.
Because that's how I started in the business.
Well, that's exactly. That's
a long time ago, 1990. But
there wasn't a lot of anyway, it's a difficult business to actually enter.
And there are still multi-level marketing companies that pitch financial products.
Yes.
I had someone come and talk to me a couple months about that, and thought it would be a good option, and it was. I'm not going to get into the total details of it, but I mean, it was.
They wanted you to sell them.
No. But I said the challenge is whether or not that one product is okay or not. It's the person leading the advice. They don't have the breadth of knowledge to know when it's appropriate or not appropriate. I said that's my biggest issue. You can't just in a 40-week class become a financial expert.
Yeah.
And
especially if you're promoting a product, because if all you have is a hammer, everything looks like a nail.
Well, how do you know? How do you even know you're doing someone any good?
Yeah.
If you don't have the other in-depth knowledge.
Yeah, it takes years.
Yeah, and I had a friend's daughter. She was 23. Came in and visited with me not long ago, and dropped out of college. And the first thing I said is, well, you have to finish college if you're going to go into this industry. So first of all, you can't get a certified financial planning designation without graduating college. Secondly, I said no quality firm is going to hire you. That's like it or not.
Oh, she just wanted to drop out of college and become a financial planner?
Yes. And so she told me she went to go work for a company to do equity index annuities.
That's not financial planning. That's sales.
That's what she was doing, equity index annuities. And I remember I kind of warned her, well, the challenge is, I mean, first of all, I don't like the products. Second of all, you're not going to know when it's the right thing or the wrong thing for somebody.
Yeah, she will. If they have money, she will try to talk them into putting it into the equity index annuity, regardless of it is the appropriate thing or not. She's a commission salesperson.
And doesn't know any different.
That's sure enough.
Doesn't know any different because it has not been educated.
Yeah, sure enough.
Anyway, why did we go off on this tangent?
I don't know. You want to take some calls?
Yes.
Let's give our number out. It's 833-99-WORTH. So it's 833-99-WORTH. And you can call us, and we'll get you on the air.
And let's go to San Jose, California. Talk with Joseph. Joseph, you're with Hanson & McLean's Allworth's Money Matters.
Hello, guys. Thank you for taking my call. Okay, my situation is my mother passed away about 2 months ago.
Sorry about that.
Thank you very much. No, she had a trust and a will and so forth and so on. But throughout the years, I had realized, and I tried to get a hold of her account since she died when she was about 93, so I had power of attorney. Every time I went to the bank, they would say, "Yeah, she has a trust, and has a savings and a checking." So every time I went to the bank, they said, "Well, you can't get access to her checking because you're not mentioned in the trust." Mm-hmm. And then of course there was the savings and the CD, and I also had problems with them.
Okay.
As far as I was concerned. Now, she of course he passed away. I got the death certificate, and they did send me, the bank did send me a letter or documentation in which I had to complete and so forth and so on. So and also indicated, I guess, on there the address in which they would mail me the money for the savings, I guess, in the CD, but didn't mention anything about the checking. So I guess my question is, I don't know. My question is, will I have any issues, any problems accessing that money?
No.
If it wasn't in trust.
No, it still doesn't matter.
Well, are you the only beneficiary listed in the trust?
Oh, no. See, I have. She decided to leave the money to my two nieces and nephews, and also indicated that I would get 1/4 of what's in the account.
How much money is in these accounts?
It's about $250,000.
Yeah.
Have you hired? Do you have an attorney helping you?
Yes, I hired an attorney.
So none of these accounts were in the name of the trust. Is that correct?
No. The savings wasn't. Only the savings was, which was like around, when she passed away, it was around $40,000.
And the rest were not in the trust.
Apparently not. No, was a savings, and there was a.
Yeah, you're going to jump through some hoops to get to this money.
Probate.
You may have to probate some of this. So what happens is you have you should have a pour-over will with that trust.
Probate's not always a long, drawn-out process either.
But it isn't. So your attorney, it might take just a matter of weeks.
My mother-in-law passed away suddenly without, on the younger side, without, I think she just had a will. Yeah, it was no trust. And it was not nearly as challenging as...
And you did it yourself?
No, I had an attorney help me.
Oh.
I mean, I did legwork on it. I sent the notifications out to the beneficiaries when you're supposed to do those things. I did those sort of things. But I still had an attorney, and the attorney's like, well, they're the statutory maximums you can charge.
But by the way, that's a maximum.
Yeah, it's not the minimum.
You could pay.
The attorney can do it for free if he
Yeah, you could pay a
chose
lot
to.
less. In fact, if you want to, and the attorney quotes you a price, you could
pay
say
a lot less for an attorney. I like that.
You could tell them I don't want to pay as much, but you need to either do it yourself or have the attorney do it.
You need to get an attorney involved because there's certain there's notifications to the beneficiaries that starts a clock. I'm not an attorney. I'm not trying to practice law here, so I don't know. So, but
so your attorney should handle it. That's what the end of
yeah.
He did say that it's possible, but it shouldn't be a problem. They could set it up, and it wouldn't be all that difficult because after all, she does have a trust.
There's probably a pour-over will in there. It's probably
There's a pour-over will.
I wouldn't worry so much about it.
Yeah.
Okay. All right.
Yeah.
Now, one question. One other question, of course, I mentioned earlier is that once again they said they wanted my address to mail me the check.
Yeah.
For the savings.
That's correct.
And I guess with the CDs. So what does that mean?
Well, they send you the check.
Yeah.
Where are they supposed to send it?
You're the trustee, right?
Say again?
Where are they supposed to send it?
Yeah, to my
they send it to your address. Give them where.
But doesn't that solve everything? They already sent me the money.
Did they already send it?
Well, they will. I mean, I guess if everything.
No, it doesn't solve all the problem. Doesn't mean it's dealt with the courts, with probate. And you've got beneficiaries, and the beneficiaries might say, hey, wait a minute. I'm not sure Uncle Joseph gave me the full accounting on this or not. I'm going to contest this.
Yeah, so you want a lawyer to step in here, and you're going to charge the estate for that. So it's not coming all out of your pocket.
No.
It's coming out of your nieces and nephews' pocket.
Yeah, it's been
about
shared.
Like that. Well, yeah, exactly, yeah.
Right?
Yeah.
So appreciate the call.
Yeah, and I tell you, it's we've seen it enough. What the challenge is, you don't know what you don't know, right?
Yes.
And we were just talking about it a moment ago about people trying to be financial advisors. They don't understand. So when suddenly you are in charge of the disposition of an estate, you don't know all the laws surrounding that, or what rights beneficiaries have or don't have.
Yeah, and you might be breaking
your
the rules.
responsibilities are as a fiduciary.
You might be breaking the rules that you don't even know exist. And you're opening yourself up to liability. That's real.
Yeah, we've seen it oftentimes. And before we take some calls, Pat, there's I found this article troubling. Well, there's been numerous articles about this. And the fact is, we've been living in the longest bull market. Granted, the market fell almost 20% a couple months ago. 19 point something intraday, but it didn't quite hit the 20. So technically, we're still in this long-term bull market. The fact is, since the great financial crisis till today, the markets have grown dramatically. Right? The Dow was at 666 at its low. Don't know why I hit that number, but anyway. Coincidence? No. We've had tremendous growth since that time. So you would think that, let's say someone who had the retirement savings was at a low, markets came back, I can breathe again, my accounts are up. Pension plans, not corporate pension plans, because most corporate pension plans don't have problems. Of course, a lot have been eliminated, but
public pension plans, on the other hand,
are in a world of hurt. So how is it that during this time of tremendous gain in the stock market, public pensions are still woefully underfunded?
And remember, most public pensions will hold anywhere between 60 and 70% of the portfolio in either stock mutual funds, or some sort of equity position. 60 to 70% of the portfolio, right? So as the market has come back, why is it that these pension plans why are they still under so much pressure? And you look at counties, city, municipalities, states, you look at, Chicago's pension plans, you look at Illinois, you look at New Jersey, you look at parts of California, the whole state of California, and then individual municipalities within the state, and districts, water districts, sewer districts, park and recreation districts, fire districts. Problems. And you would have thought that this bull market would have fixed a lot of these, but it hasn't. So why are we talking about this, Scott?
Well, because I think it impacts everybody. If you go back since 2007, so right before the downturn, and this is from data from the Boston College's Center for Retirement Research, assets in the pension plans are up 30%, but the public pensions, their liabilities are up 64%. So even in these times where the markets are doing good,
the promises continue to grow. What's a liability? It's a promise. It's a promise to pay someone or pay someone now.
It's interesting. On the corporate side of things, company pensions, United Airlines as an example. We're all familiar with United. Most of us have flown United before, right?
Yep.
Most of us know some pilots. If not, we have friends that know pilots, right? When United went into bankruptcy,
what did they do?
When there's bankruptcy, you don't have enough assets to make good on all your promises.
Your liabilities have become...
The pension plans for corporate companies are backed by the Pension Benefit Guaranty Corporation, the PBGC. It's a quasi-government agency.
It's kind of like the FDIC for pension plans.
Kind of. And companies pay in a premium, as an insurance premium, essentially, to guarantee their plans. But there's caps on it.
It's not unlimited.
Just like with FDIC, there's a cap, $250 million. So
$250,000.
$250,000. So if Bill Gates had all his money in some bank and it went bust, it'd say, sorry, Bill, we're only going to give you $250,000 worth, right? So there's limits on it. Same thing when it comes to these pension plans with corporate pensions. So the limit it's about $45,000, $50,000 a year for a 65-year-old. So what ended up happening with their pension plan? Well, any lower paid employee or a lower pensioner continued to receive benefits if nothing changed.
Got it all replaced.
It was primarily the pilots, unfortunately, that had the reduction in it.
Significant.
So we see this limits when it comes to bank insurance. We see this limit when it comes to corporate pensions. There is no limit like this when it comes to public pensions.
And that's going to be an issue. That's going to be an issue. So these, you've heard us speak about these before. This is a massive game of kick the can, addressing the issues with public pensions. Massive game.
And while the federal government can print dollars,
the states and municipalities cannot. So
you're retiring with a six-figure pension somewhere. Awesome. I'm really happy for you. We really are. But you might want to make sure that what happens if in 15 years from now it gets reduced?
Yeah, they claw back a little bit. And people say, well, it would never happen. We don't know. I don't know. So. We always again, make sure that you've got a sound retirement plan that can handle whatever storm may come. So right before we close here, we're going to let you know we've got some live workshops coming up in the Sacramento region. So if you are in the Sacramento region, we've got them the week of May 13th. We are doing our Retiree Beware series. These are the people and products that you need to avoid as you're nearing retirement or in retirement. So we're going to go over all the different kind of financial products that are being pitched and how to have your radar up for knowing when, this might not be something I should be investing in. So it's the week of May 13th. Tuesday, we're in Elk Grove. Wednesday, the 15th, in downtown Sacramento. Thursday, the 16th, in Roseville. All the evenings at 6:45. Saturday, May 18th, we'll be in Rancho Cordova at 11:15. All the information and to make reservations, go to allworthfinancial.com. And unfortunately, we are out of time. We'll see you next week. This has been Allworth Financial with Scott Hanson and Pat McLean. Enjoy your weekend.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.